Now, before we begin, we just want to remind everyone, of course, that the United States markets are closed on Monday, July 5th, in honor of the 4th of July, in honor of Independence Day. So, of course, there will be no market activity on Monday, and we'll start our trading Tuesday for a shortened week next week. Comment did come in. Can you quickly explain the comments you make about debit to strike difference ratio in a calendar spread and why you feel it is important? Okay. We're talking about a calendar spread, and in the case when I apply the debit to the strike difference ratio, we're talking about a diagonal spread, a poor man's covered call or the poor man's short covered call. For example, this, the reverse of that would be the calendar put. But when I look for a diagonal calendar spread, buying a call option, slightly in the money, far out in time, and selling a near term at or out of the money position against it, to mimic sort of a covered call trade, but using leverage to buy the in the money call a few months out in time as opposed to buying the stock directly. This is a good way to trade higher price stocks that might not match your portfolio. I'm going to take this Abbott example because it's at 118. So instead of me paying $11,800 to buy 100 shares of stock, I could buy one contract of the June 2022 110 call, slightly in the money, for $1,500 rather than $11,800. Does this give me direct one-to-one similar ownership as to buying the stock? No. It is not an exact replacement. Of course, the diagonal calendar spread has some issues with it, which we'll talk about in just a moment. Well, not issues, but there's things you've got to consider that it doesn't make it exactly like a covered call. It's not just, hey, I'm doing the same thing I do on a covered call, but I'm paying 1/10 of the price. No, it's not that at all. There are other components involved here. Let's get to the point. The debit to strike difference ratio. I always look for a debit to strike difference ratio of less than 1. This means that the net debit that I'm paying, the price I'm paying for the call option that's several months out in time, minus the call premium I'm receiving from the near term, the debit I pay to get in the transaction has to be less than the difference in strike prices. Debit divided by a difference in strike of less than 1 gives me only those positions where the net debit is less than the difference in strikes. Why is that important? This isn't likely a position I would use. I think the call is too far out of the money. The August 130 is only trading at 49 cents. But we'll take a look at why it's important. Let's go to the profit and loss chart. What are we doing again? Let me extend this out a little bit, get a better view of the profit and loss chart real quick. What are we doing? Instead of buying the stock again at $118 per share, buying 100 shares will cost me $11,800. I buy one contract of the June 2022 110 call, 350 days out in time, for $1,458, or about $1,458 rather than $11,800. And I'm going to sell an August 130 call for 52 cents against it. So my total net debit is $1,406. That's what I'm paying out of pocket to enter into this spread. And we have what? We have a 20-point difference in the strike prices. So my net debit is less than my difference in strikes. Why is that important? Now, this is a far out of the money one. This is one I said I probably wouldn't necessarily do. I'd be looking probably in this case on Abbott, maybe looking at July, maybe looking at the 120 or the 125, or maybe going to the August 125 for a little bit better premium, based again on what my outlook is for the underlying security. What is this graph showing us? This is showing the profit and loss chart on August expiration, the near-term expiration of the two options involved. And this return is based on the theoretical value of my long option, my June 110, if the stock was trading at these prices on August expiration, also, of course, depending what the buyback cost might be on the short call. Let's extrapolate on that a little bit. Let's say our stock does go to 125 on August expiration. what can we assume without even running the calculation what's going to happen? Well, both options are going to go up in price. But right at August expiration, my 130 thankfully is still going to go to zero, but we're going to see some gain in this 110 call, although we may experience some time value, but the intrinsic gain should more than make up for it. As we expect, on August expiration, the 130 call goes to zero, and we gain almost a little bit more than 500 points, 540 points, 530 points roughly, on 110 call. So we'd have a profit, in this case, of 578. In theory, based on the pricing models, if our stock was trading at 125 on August expiration. Now, let's do another example. Let's take it up a notch. Let's say that on August 20th, Abbott exceeds our expectations, moves up to 135. Well, now what do we know? We know our short call is going to cost us $5 to buy back per contract. It has $5 of intrinsic value. We're going to have to roll this call if we want to stay in the position. And this 110 call, which is now 25 points in the money, is going to be worth $27.84. So that still leaves us $284 of time premium. So we have $2,500 of intrinsic. We've only gained $1,300 on this option, but we have $25 of intrinsic value on a 110 call, and that would leave us with $284. Let me clear that up there. $284 of time premium. And so we'd have a profit here of $878. Now, if the stock was trading at 135 on August expiration, and I didn't roll the call beforehand, I didn't roll my August call beforehand that went in the money, I left it alone, what's a likely outcome that hopefully my broker would take? Sometimes this doesn't happen, and that's even worse, but the likely outcome is my broker is going to exercise my 110 call for me to deliver the obligation I have to deliver shares of stock at $130. So I'm only going to get 20 points back. I didn't get the extra $284 here because I didn't take advantage of the time value. This is under the assumption that I'm able to sell to close that long call at the near-term expiration and get back the time value that remains. But if I let it slip, I didn't do anything, or I got assigned early. If Abbott ran up to 135 on July 20th, and I was assigned early, I only get intrinsic back. I don't get that extra time value, which is based on the returns. I don't see the 878 in that case. I see the 20 minus the 1450 or 1460 it took us to get in the position. So I only make 540, not the 878 I was expecting, because that's based on the time value. Now, going back to the question, why is it important to use the debit to strike difference ratio of less than 1? In this case, 20-point spread. And yes, I'm only collecting 50 cents, but let's keep that. But let's say it cost me $22 to buy this 110 call. Even though it's a small amount, in this case, my debit's 21. Let me clear this up. We're going to put that at 50. Just use a nice round number. Perfect. All right, so now I still have a 20-point spread, but my debit is $21.50. Well, that's okay. I'm still expecting a 10.3% return. Notice what else happens here. On the other graph, even if we went up to 140 or 145, 150, we didn't see the position dip back down into the negative. Now, we're probably not expecting this big of a move up to 160, 155 on Abbott in the next 40 days. If we did, we're probably doing a different strategy altogether, not a calendar spread. But the other spread we had that had the difference in the net debit, less than the difference in strike prices, trailed off as all calendars do, but it didn't go negative because it can't. Because even if I only get the intrinsic back because my broker had to exercise my long call to deliver the short, an early assignment, I'm still getting $20 back minimum. Well, I'm getting $20 exactly back, and my debit was still $14.50. Now, if the stock suddenly shoots up here to 155, 160, and I'm assigned at 130 early, my broker exercises the long to deliver the short. Let's say what happens if the stock is at 150, a sudden move in price. This is where things get tricky, because we'd expect the loss here, as we just saw, of about $29. Now, part of that is due to this other factor here. We'll talk about that very quickly in just a moment. Why does it trail off this way? Why does it go negative? I'll address that in a moment. But if the stock goes up to 135, we're expecting a return of $65. Not great, but we're still expecting a profit. But again, if the stock suddenly shot up to 135, we're expecting, okay, on 820, we're expecting a profit here of maybe 130 or so. At 140, it sort of goes lower than that. But again, if we let it go to expiration, this profit is based on the value of this option and taking advantage, being able to sell to close it, to take the time value that still remains. If I'm assigned early, I only get $20 back. My debit was $21.50, so we're actually at a loss of $150 on this trade. We expected a profit because our net debit was less than the difference in the strike prices, and we allowed it to be assigned without managing the position. Why does, in any calendar spread, whether it's done the way that I prefer to do it, and answering the question here of why is it important that we talk about this debit to strike difference ratio, making sure the net debit is less than the difference in the strikes, why does it trail off here as you go above the strike price, your sold call strike price at the near-term expiration? And even though my 110 call has a higher delta, and in fact, on that search, we were only looking for positions where the delta of the long divided by the delta of the short had a delta ratio of at least 1.6, meaning the delta of the long is about 60% higher than the delta of the short. But what happens at August expiration? What happens at the short-term expiration as the stock starts to climb above your short call strike price is that your near-term option is now automatically going to a delta of 1, sorry folks, or 0. And if it's going in the money, it's going rapidly to a delta of 1. And at the minute of expiration, it has a delta of 1. Your long-term option, in this case out to June 2022, this 110 strike we were evaluating, yes, it has a high delta when we open the position. Right now, it's probably at about 0.7, 0.65, probably a little higher. But even with the stock going up to 140, and this being another still 200 some odd days out in time, the delta is probably only at 0.8 or maybe 0.85. Meaning now at August expiration, for every dollar the stock gains, I'm losing 20 to 50 cents because my long option is only gaining 0.8 or 0.85. The short option, the one I have to buy back, is gaining $1 or close to it in that case. So that's something that you want to consider. This is why we look at the delta ratio. And this is why in any calendar spread, diagonal spread, poor man's covered call, you see the profit and loss chart trail off after you cross the short option strike price at expiration, because a short call, or if you're in a calendar put, the short put, once it goes in the money, it's quickly going to a delta of 1. Your long option is not reaching there as well. And in case of early assignment, that's why we always look for the net debit of the diagonal spread to be less than the difference in strike prices. Going back, I'm going to go back real quick to our original position that came up on the search for Abbott, which had the proper debit to strike difference ratio we wanted to see. See, look, it never goes negative because of that factor, 170, 180, whereas if my net debit was higher than the difference in strike prices, we saw it around 150, we crossed into a negative range. As a management technique, Don comments, would you consider buying the long stock before it reaches the strike of the short call? Personally, no. It is a consideration. If you're letting it go in the money, Don, and you know you're going to be assigned, you may want to consider buying the stock if you have the capital on hand. For me personally, when I trade this strategy, I trade it with only about 10 or 15% of my total portfolio value. The other, I'm using a larger portion to trade the married puts and standard collars. I'm using 10 or 15% bull put credit spreads, so on and so forth. So With this allocation that I have on maybe the 2 or 3 calendar spreads I might have open at this time, I don't have the capital to buy the stock in that portion of my portfolio because that's not what I wanted to do. What I would consider in that situation is if the stock's moving up here, if this was a short-term play for me, where I wasn't planning on continuing the diagonal spread, quote unquote, poor man's covered call, and I've hit my goals in this case of about a 840 profit on a $1,400 investment at August expiration, if the calculated prices are near, then I might just liquidate the position, sell to close my long, buy to close the short, get out of the position. I've hit the target that I wanted. If I want to stay in Abbott because I think it's a strong position, I think it has more upside growth, I'm going to treat it just like a covered call, Don. I'm going to buy to close this call, now maybe roll it to the 140. Depending on the time frame, maybe keeping August expiration, but most likely I'm going out to September to try to roll for a credit if possible. Meaning the original premium we took in, the 50 cents here or so on the short call, minus the buyback cost, plus the new premium. If that's still positive, I consider that rolling for a credit. I'm still reducing the cost basis of the long, and I'm pushing my max profit up in that case. So I wouldn't buy the stock personally because that's not the approach I'm using with this portion of my portfolio. It's just a small portion of the portfolio used for leverage trades so that if a market event comes up and my calendars drop 30, 40, or 50% in a 2-day period because of an 8 or 9% drop in the market or in my stock, then I'm only down 7, 6% of my total portfolio value. I haven't given up that much. But again, it is a way that you could buy the stock here to cover the obligation, keep the long call, and then continue on likely in that play. But I would just look to roll the position as it starts to go slightly in the money if I want to stay in the trade, just as you might roll a covered call or a bull call debit spread. Speaking of which, if this had a good run and I rolled this up to, let's say, the August 140, and then it continued up and I rolled to the September 150, and I'm still holding the 110, at this point, I might sell to close the June 110 and move it up to the 125 or 130. I'm pocketing some of this gain here that I've taken on the position, using that almost as a way to average down the cost that I have remaining in my new strike price here at the high. It's just another way to manage the calendar spread. We're not going to get into that right now. The different ways one might consider managing a calendar spread. We'll save that for another time. Buying the stock, yes, can be done, but it wouldn't be the approach that I personally would use in this scenario. I would just look to roll the call, or if I've met my goals early, to liquidate the position and then find another trade if I'm more bullish on other stocks that I am continuing the stock that I was just in.